kick it off with the year-to-date performances so far. We've got the SPY down 12.59%, NASDAQ down 23.04%. So that is lagging behind quite a bit still. We've got IWM down 12.66% and DIA down 4.45%. The Dow Jones is bullish trend. The next one nearing Momo is SPY. So we'll see if we can get that or if we will get a bounce off of Momo and back down. Right now, our system regime is still showing stagflation, so the odds of a bounce off of Momo and continuing risk off going downwards are more likely. But we are seeing an underlying shift in growth, as we talked about last week. We did say these GDP numbers are going to surprise to the upside, and that's exactly what we got because we are noticing growth rising. Let's take a look at the calendar for next week. We've got pretty slow week, honestly. Monday, we've got factory orders, ISM services index. Tuesday, we've got international trades in goods and services. Wednesday, we've got productivity and costs, EIA petroleum status report. Thursday, we've got jobless claims, EIA natural gas report, and the Fed balance sheet. Friday, we've got PPI final demand, consumer sentiment. So it's a pretty slow week. The biggest would be the jobless claims. Keep an eye out for that on Thursday. As we know, the Fed is watching the jobs numbers, so that really dictates their policies. But at the end of the day, they do seem to just be following whatever the futures are pricing in, which we will talk about later.
Yes, and let's go into some important releases this week. So we had the Personal Consumption Expenditures Index, the PCE. Headline numbers come in at 6.27. Month over month, we saw the numbers at 0.34. And we had the core numbers come in at 5.18 year over year and month over month at 0.46%. Now, both of these numbers came in on month over month as a month over month rate of change is lower than their estimates, meaning they both came in to the downside, signaling that upward price pressures are easing. Now, this is what people want to see in regards to the talks of inflation. Obviously, this is not the inflation index, but this is a closely related index that does incorporate the consumption costs and what people are personally consuming. The Fed does watch this. They've said it. They made us aware that this is an important metric that they use to monitor inflation. And as long as these numbers do remain elevated, though, they will continue to add upwards pressure to the inflationary conditions that we're feeling, that everyone's feeling, right? We also saw the GDP numbers come in at 2.9% year over year positive. So we had those two negative prints. Now we're back in the positive territory. Again, this is something that many people are very confused about, right? Because if we take a look at what's going on with the economy as a whole, you see growth coming down in the market, right? The way the market's being perceived is growth is down, so is and inflation is up. We have this stagflationary environment where a lot of the market is in the shitter, right? Everyone's like, "Oh man, the market's it's not a bull market, right?" But it's not a bear market either. It certainly feels like one, but there's not really a constructed, or I should say, a direct selling of equities, right? You're not seeing that. It's almost like it's still so like in a program where we're selling, bidding, selling, bidding. We're not really going lower and staying lower. And people are very confused because in an environment with what we're experiencing with super high inflation, all these layoffs, you would expect growth to be falling apart. It is yet to do so, though, as we're seeing here. Now, this leads us to where we are going to go in the future, right? What's going to happen here? Well, it's very likely that growth does come down at some point, right? I mean, given that the economic conditions of high inflation, job losses, things are going to start affecting the economy as we go down the road, right? Especially specifically growth. Growth will eventually slow, but you also have to look at it from another perspective, right? Inflation has been high for so long, right? So now we've seen this growth fall off. As you can see by this chart here, we were coming from obviously this post-COVID snap up of 32%. We're now down at 2.9%. So growth has come down a lot, even printing two negative consecutive quarters earlier this year. Inflation on the other end has not come down. So the problem we're going to run into here is, does inflation stay up so long where growth actually can come down, bottom out, and reverse before inflation rolls over? The reason I'm saying this is for us to get that typical recessionary bear market regime where bonds or treasuries are going to outperform equities, you're going to need to see a simultaneous move of growth and inflation lower. Now, if growth already made that move, which again, it's likely we'll get some type of area of negative prints, more than these two that we've been seeing. But for the short term, it looks like growth is holding the bid. Now, if growth does not move under and print these negative consecutive prints and does rebound and inflation does stay high, we would get what we would call an inflationary regime. Now, even if inflation does curb and roll over, but growth is bottomed, at least for the short term, there is going to be what we call an expansionary regime, both of which are risk on.
Yeah,
And
so
that's
both of which we would go long Nasdaq in both of those regimes.
right. And that's something that most people are not prepared for because, again, I know this is a lot of information. It seems like it's squeezed in a very misunderstand or convoluted way. So let's simplify this. Real simple now. Growth needs to go lower for the market to really fall apart. If
Right.
growth doesn't go lower, what's going to happen is the market's going to start picking up on the idea that growth has bottomed. Growth declines have bottomed.
Right.
And if
And
that happens,
growth is the underlying driver of all bull market rallies.
of course, without growth, you don't have a bull market.
Right.
So unless we see an actual bottom being formed here, or I should say, if this is not a bottom, then there is good chance that market has the potential to go lower. Now, if this is a bottom, well, then we might have seen the lows in the market. Now, this brings us to ES and what's going on, right? So let's remove some of these drawings so we can see what's going on here. ES has come off the October lows all the way up to Momo now. We're just under Momo, about 1.23% away. What's going to have to happen here is two things. We're going to have to see a regime pivot. Okay, we're going to have to see the regime lift out of risk off into risk on. And we're going to have to see the major indices roll up into bullish trend.
Hmm.
If
And
those things,
we are very close.
we
The
are.
system is very close to flipping to a risk on regime, but it hasn't happened yet. We're not going to front run it. We're going to wait for that to happen. We'll see if it happens. If not, we're staying cash.
Exactly. Now, the most important thing behind this signal is that it has a checks and balance component, right? So our risk on is merely an environment, right? So is risk off. It's not an action. To derive an action from a signal, our action, or at least to derive our actions from our signals have to be checked. So our actions have higher confidence, and that's what the whole point of DDAP and the system combining together. That's that system, right? The DDAP and the system combined together is what we would generally call our system. Even though the system has its own name, you get the point. The system itself is the idea of using the system, which is the regime model, and DDAP, which is the trend model, combining them together to get the ultimate system. And the system itself, those outputs are read by our portfolio models, one being Aries, and Aries gives us the definite buy, sell, or flat signal, and what we are long accordingly. Long equities, long bonds are just flat. Unless we see a regime pivot and a subsequent trend pivot, Aries will remain flat. And the reason Aries is flat comes down to bonds. In reality, in this environment, which is stagflation, right? We would be long bonds. The normal trade for many people this year has been to try and buy bonds because they see equities going down. Remember, risk off, usually risk off environments are full of bond opportunities. The problem is this time we are in a different environment than what most people have ever seen most people have ever seen, and those that haven't seen them in multiple decades.
Right. And that's
And
why so many people got destroyed this year.
right. I mean, look at bonds. Bonds, we got the full bearish trend trigger on DDAP on long-term bonds up in August of 2020.
Right. And for normal portfolio managers, like the your staple financial advisor, their models are if equities are shit, you buy bonds. That's basically what they do. Equities were
Right.
shit, so they were buying bonds, but they were also getting destroyed on bonds. This is why you need to have a model like what we have, which is like a catch 22. Both things, everything needs to align. And in this case, in the case of bonds, the system aligned, but DDAP did not align. So we stayed away from bonds, stayed cash. And that still
Right. And
holds true today.
yeah, and that's the big reason why Aries is flat right now. Aries is black and white, right? There is no nuance with Aries. There's no outside of the hedging aspect, which we'll go over that when we get there. But in terms of direction and alternate positions, it's either going to be long equities or long bonds. It is not going to be short anything. Aries doesn't short. It longs either bonds or equities. So we're in risk off, obviously, given the stagflation trigger, but bonds remain bearish trend. Remember, checks and balances. Aries is going to look at the system, which is stagflation and DDAP is bearish. Combine those two, right? Now we have the system saying that it's a low confidence risk off regime. Aries is going to say, okay, there's not enough power here for me to put a position on. I'm going to remain flat. So Aries, again, black and white is telling us this is a cash is king regime. And until we get some type of regime signal, it's going to be pretty boring. But that's okay. We can sit here and watch and make sure that when the pivot does happen, we take advantage of it to the fullest extent possible. And this also brings me to the point of what bonds have been doing in the last 2 weeks or
Yeah,
3 weeks,
what
I
what
should say.
exactly does this rally mean? Because this rally is not insignificant. This is the biggest bond rally we've seen and the fastest we've seen in a long time.
Yes, and I would go. I would the way I would approach this is look. Obviously, nominals are off their highs, and if we look at long-term bonds, we got to look at long-term yield. So let's look at the 30s, right? Look at the 30s. They were printing four and almost 4.5. Now we're under three. We're at 3.5, right? So we're down quite a bit. We're still not bearish trend on the 30-year nominals yet. So it's something to watch out for. I mean, even though bonds are bearish, right? It's not like yields are bearish and like it's a weird coincidence, right? Yields aren't bearish just yet. And the other thing is obviously we've seen the terminal come off its highs, right? We were just remember when the 30-year was sitting at like 4.25, 440. The terminal was almost 530, 530 basis points. It was up there,
Hmm.
and we've seen the terminal come down quite a bit now. Now we're under 500 basis points, I believe, as of as of Friday's print. That terminal curve will be updated in our Fed forecaster, excuse me, which is the Fed terminal rate, which will be updated in the weather report on Sunday night. But I want to talk about where the Fed funds futures have been signaling, at least in the past 2 weeks. So Friday, Black Friday market close. This is the screenshot of the estimated number of FOMC hikes slash cuts expected to be priced in the next meeting, in the next few meetings, right? Now, obviously, the further you go out in time, the less predictable it becomes, and that's just primarily due to the fact that things, events, tail or not tail, can happen in that time period that will alter the outcome of what the Fed is expected to do. Long story short, the Fed forecaster was having the Fed hiking a solid 100% chance of 2 rate hikes and 17% chance of a third rate hike. So the idea of 50 basis points, even though Powell came out and basically signaled this week that there is a chance that we could see the slowing of rate hikes um, as soon as the December meeting. This has already been priced into the market for a while now, and Powell is just basically reiterating what the futures are saying. So
Right. And
it
so the bonds are essentially pricing that in. This
right,
rally in bonds is the bonds knowing that the Fed is already going to be slowing their pace of hikes and that inflation has likely peaked.
right, and
That's
what I
essentially what
want
they're saying.
right, and where I want to leave this podcast off today is with his remember hiking, pausing, and cutting are three different things. Hiking and pausing and cutting, they're not the same thing. So when the Fed says that they're looking to slow the pace of rate hikes, right? They're eventually going to slow it to the point, and just we can look at even though this is outdated, you can get the drift here that we're going to slow to the point where we pause, right?
Hmm.
We are
And
not slowing,
that's still not a bond long environment.
right?
You don't
Right.
want to be long bonds if they're not cutting. You're going to get chop.
And that's the biggest fear that we have right now with ZB, right? Obviously, the Fed's not cutting yet, and even the Fed's not really pausing yet. The Fed's just slowing. So it's hiking, slowing, pausing, cutting, or even like I said earlier, hiking, pausing, cutting. None of these things are the same. They're all different. For you to get that real nice bond setup, you need the Fed to be cutting, or at least about to cut. We're we're still far away from the Fed even thinking about cutting rates.
Yeah. And
They're now
when we get the cuts, that's where we get the 50-60% moves on triple leveraged bonds. And that's what we're here for. That's what we play for is those big moves. We're not here to mess around with, catching tops, catching bottoms. We catch the meat of the moves. So we're not worried about being late. For ZB to go bullish trend, it's got to be above Momo. We're not worried
yeah,
about that. We're still going to catch the move. We always do. Our system always does. That's how we get our 32% compounded growth rate.
and I think that's where we'll cut it off today. Thank you so much, guys, for listening. If you have any questions, feel free to reach out to us on Twitter at the Market Radar or visit our website www.market-radar.com.